Hello! Today we will be discussing lump sum purchases. A lump sum purchase is when a company purchases several assets for one price. Lump sum purchases pose a problem for accountants because each asset needs to be recorded separately in the accounting records. This can be an issue when assets are not purchased individually, but instead at one big lump sum price. As we will see shortly, the market value of our assets plays an important role in the accounting for lump sum purchases. So the problem says that Green Acre Farms recently made a lump sum purchase of assets. On January 1st, 2009, the company paid a total of $500,000 cash for land, a building, a combine, and a tractor. The market values of those assets are $300,000, $150,000, $90,000, and $60,000 respectively. We are asked to prepare the journal entry to record the purchase of these assets by allocating the lump sum purchase price. So I'll start out by showing you the intuitive solution and why maybe it doesn't work out so well. So we know that this company received land, a building, a combine, and a tractor from this purchase. So since those are all assets, we can debit them in our journal entry to increase them. Next, we know that the company is paying $500,000 for all of these assets. So we're going to have to credit our cash account to decrease it by $500,000. Next, you might think since we have all these market values that we should record those for the value of each asset. So let's try that out right now. So the land is at $300,000, the building at $150,000, the combine at $90,000, and the tractor at $60,000. Now the problem with this solution is if you were to add up all of your debits, you'd notice that they actually add up to $600,000, which doesn't balance with our $500,000 credit to cash. So what we're going to have to do is modify each of these debits using some process in order to get them to balance to the $500,000 credit to cash. And I'm going to be showing you that process throughout the rest of this video. So if we look over here to the right, we'll see that I have a chart that we're going to be filling out as we complete this problem, as well as instructions on how to allocate the cost for assets in a lump sum purchase given the total cost paid and the asset's market value, which are two things that were given in the original information. Let's start by copying down the important information. So we have the market value for each of the assets, which was listed over here. So let's type those in. Next, we also have the total cost, which is the $500,000 cash that we paid for all of these assets. Now we can start with step number 1, which is to calculate the total market value by adding all the asset market values together. So here are all the market values for each of the assets, and if we were to add all those up together, we would get a total of $600,000. Next, we can calculate the percent of total market value for each asset using the following formula, which is that the percent of the total market value is equal to the asset market value divided by the total market value. So if we go to this column right here, we need to take the assets market value, which is $300,000 in the case of land, and divide that by the total market value, which is $600,000. And that gives us that land is 50% of the total market value. Now we can do the same thing for the building, $150,000 divided by the total market value of $600,000, which gives us 25%, and we can do the same process for the remaining two assets. And you can also add up all the percents together, and if you've done everything correctly, they should add up to 100%. Now if you're using a calculator, then you're going to be getting the decimal equivalents here, so 0.5, 0.25, 0.15, and 0.1. And I'm just showing the equivalent percentages here because it makes a little bit more sense to think of it in the context of a percent of the total market value. But the decimals are also just fine. Next we can move to step 3, which is to calculate the allocated cost for each asset to be used in the journal entry using the following formula, which is that the allocated cost is equal to the percent of total market value multiplied by the total cost. So if we go to the allocated cost column, we need to take the percent of total market value, so that's going to be the 50%, and again you're going to want to use the 0.5 if you're typing this into a calculator. Multiply that by the total cost, which is $500,000, and that will give us an allocated cost of $250,000. We can do the same thing for the building. Take 0.25 for 25% and multiply that by the total cost to get an allocated cost of $125,000. And you can do the same process for the remaining two assets to get the following costs. And once you've done that, you can add all those numbers together. And what you should get, if you've done everything correctly, is $500,000, which is the same as the total cost. Now notice what we've done here. The total market value of $600,000 doesn't match the total cost of $500,000. And since this total cost is going to act as the credit to cash in our journal entry, we need the total of all the debits to equal $500,000. So therefore we have to reallocate the market value to equal $500,000 once we've shrunk them down. So notice that's what we've done. We had $300,000 for the land initially, and based on the 50% contribution to our market value, it's going to have an allocated cost of $250,000, so a little bit smaller than it was before. Same thing with the building, $150,000 became $125,000. And continuing for the combine and the tractor, same situation. So that when you add them all up together now, it does equal the $500,000 total cost. So now we can move back to our journal entry. So I'll move this text box back down. And we can use the allocated cost as the debits in our journal entry. So land, that's going to be $250,000. The building's going to be $125,000. $75,000 for the combine, and $50,000 for the tractor. And if you were to add up all these debits now, you would see that they do total to the credit to cash of $500,000. So we are finished with the journal entry. So all you need to remember is these 3 steps and a couple formulas, and you should be good to go for any lump sum purchase problem.